Hi there, young learners of economics. It's my pleasure to take you on to study yet another topic in economics. We have learned various topics in microeconomics. Now it's time to broaden our horizons, yeah? So we're going to learn about something new today, but from the field of macroeconomics. So let's see what that's all about. Let's begin. Well, this has been a rather common sight at the time of the pandemic, wouldn't you agree? And it doesn't spell out something pleasant if it reflects a lack of business activity taking place between this establishment and the customers, perhaps. We know because of the restrictions, this business would perhaps have to be forced to close down till a safer time period occurred. Well, what if such a situation happened between countries? And what if countries would not interact with one another? Then literally they would be closed to the rest of the world. But we know that interactions do happen and really must happen because everyone stands to gain where collaboration or cooperation is concerned in terms of business activity taking place between countries. Now in this case, we would say that the economy is a closed one. What is a closed economy? It is one that does not take part in international trade. It is just the opposite of what we call as an open economy. And a typical example of a closed economy would be the one we see in North Korea. A closed economy has to somehow contend with the resources and goods and services available at hand within their economy, which means they don't transact with the rest of the world. And that pans out to be a very difficult situation, especially for the people living there. There is a lot we can talk about the closed economy, but thank God that we in India have an open economy. And that is what we're going to deal with in this video. Specifically, we're going to learn about balance of payments. Now, an open economy would be one that has interactions with the rest of the world. Every country depends on another, perhaps for resources, for goods and services, or even manpower. We know that manpower can be outsourced. So many of our parents work abroad. So many of our family members work between countries. So we do need to depend on other countries economically. And in such a scenario in the world, everyone stands to gain. So let's see what we're going to learn today. In this module, we will study about concepts like open economy, balance of payments, what are the components of the balance of payments accounts, and the balance of trade. What is an open economy? An economy that trades with other nations in goods and services and financial assets is an open economy. As you can see in the illustration here, countries are trading with one another, they're trading manpower, they are going on holidays, touring to other countries, they produce in other countries, they buy goods from other countries, and they even share resources. They even exchange currencies. So there is a movement of goods, of services, and of money between countries in an open economy. We all know that business enterprises, organizations, firms, sole traders, joint partners maintain accounts of their income, their expenditures, profit, loss, financial assets, and so on. So how much more important will it be for a country to maintain records of transactions that happen between them and the rest of the world? And that brings us to define what is called as balance of payments, or BOP in short. Balance of payments refers to statements of accounts recording all economic transactions of the country with the rest of the world. I want you to take a look at this illustration here. You can see there's a weighing scale, and on one hand you have exports and the other you have imports. Well, you can see that here the imports are heavier or more compared to exports. And you know, the good thing about exports is that if we export more, we earn more as a country. We earn foreign exchange because other countries pay us in their currencies. Whereas when we import goods from other countries, and if imports increase, that means we are making more payments in terms of foreign exchange. And we don't want that happening. And so you can see these guys here, they are trying to increase exports and try to make exports heavier. So if we export more, that means we're earning more foreign exchange. And if we import more, we will be paying more foreign exchange to other countries. And we don't want that situation. So each country enters into economic transactions with other countries of the world and so receives payments from through exports and make payments to other countries on account of imports. And balance of payments is therefore a statement of account of such receipts and payments. According to Kindle-Berger, balance of payments of the country is a systematic record of all economic transactions between its residents and the residents of foreign countries. Now this brings us to the components of balance of payments. Balance of payments are broadly split into the current account and the capital account. The first component of balance of payments is the current account. What is the current account? It is that account which records imports and exports of goods and services and unilateral transfers. We understand exports and imports of goods. Let us try to understand what is meant by export and import of services. Well, export and import of services is considered as export and import of invisibles, unlike physical or tangible goods. We were talking about import and export of goods. They are also known as import and export of tangibles or physical goods. Move on back to export and import of services. The payments on accounts of invisible trade, in other words, export and import of services, includes the following. First, factor payments. We know that many transactions happen by means of services. People invest in other countries, they earn profits. If they buy shares, they earn dividends. If they have given something out on rent, they get rentals. So those kind of factor payments would figure here. The second is non-factor payments. Payments for non-factor services like shipping, banking, insurance, law, legal services, and so on. The third part of the current account is unilateral transfers. What is unilateral transfers? It refers to one-sided payments, which means nothing is exchanged for these transfers. You don't get anything in return for such transfers. For example, aid to flood victims, donations, grant and aids given to other countries, and so on. Therefore, the components of current account transactions are related to the following. Exports and imports of goods and visible items like, say for example, crude oil, gold, automobiles, mobiles. We know we get so many goods that are imported. We ourselves buy goods that are imported. So we know various examples of goods that we in India import from other countries in the rest of the world. Then you have exports and imports of services and invisible items like shipping, legal services, financial services, outsourcing of manpower, and so on. And then, of course, thirdly, we have the unilateral transfers, which are donations, gifts, grant and aid, scholarships, remittances, which are one-sided payments. On the other hand, we have the second component of the balance of payments, that is the capital account. What is the capital account? It is that account which records such transactions between residents of a country and the rest of the world, which causes a change in the assets and liability status of the residents of a country or its government. So if there is a change in assets or if there is a change in liability of the country, then all those items would figure under the capital account of the balance of payments accounts. The components of capital account are broadly classified as under foreign investment, second borrowings, and third part would be change in the reserves of gold and foreign exchange with the central bank in the country, and in our case in India it is the Reserve Bank of India. The first component of the capital account of the balance of payments accounts is foreign investment. And foreign investment in turn is divided into foreign direct investment, or FDI as we commonly know it, and portfolio investment. What is foreign direct investment? It refers to the purchase of assets in the rest of the world which allows control over the asset. For example, purchase of a firm by Tata in the world. You know, way back in 2008, Tata acquired the company Jaguar from UK, and it also bought Land Rover from Ford. And the two were joined together or combined in 2013, and they formed the Jaguar Land Rover Limited. And it is a subsidiary of Tata Motors, which is owned by the Tata Group. So we often think that FDI is only other countries invested in India, but you know, India is also invested in other parts of the world in terms of acquiring assets, starting business firms abroad, which are owned by Indian companies. So that's something nice to hear, right? The second one is portfolio investment. It refers to the purchase of assets in the rest of the world without any control over the assets. So in this case, for example, purchase of some shares of a company by Tata in the rest of the world. So when you purchase shares in another country, you don't really own the company, do you? You are just a shareholder. So such kind of an investment is called as portfolio investment. The second part of the capital account of the balance of payments accounts is loans and borrowings. Now this again is divided into two subcomponents. The first being commercial borrowings and the second is borrowing as external assistance. Let's take the first one, commercial borrowings. It refers to the borrowing by the country from the international money market. This involves the market rate of interest without consideration of any concessions. So it is done for purely business purposes. You can borrow from the international money market. You can borrow foreign exchange to make payments for imports and so on. Now, since that is done with the intention of making a business, or for business purposes, there is no consideration of any concessions. As opposed to that, we have borrowings as external assistance. Now this refers to the borrowings by a country with consideration of assistance. It involves a lower rate of interest compared to that prevailing in the international money market. So perhaps third world countries, countries that are poorer in comparison with other countries would be given loans at lower interest rates, and that transaction would come under borrowings as external assistance of the capital account of the balance of payments accounts. And lastly, the third component of the capital account of the balance of payments accounts is change in the reserves of gold and foreign exchange with a central bank in the country. And in our case, as I told you earlier, it is the Reserve Bank of India. So if the Reserve Bank of India buys more gold reserves, then that would figure in the capital account. If the Reserve Bank of India acquires more foreign exchange, then that transaction would also come under the capital account, under the third component, that is change in reserves. Sometimes countries would sell their gold reserves, which has happened recently in India. We have heard that gold reserves have been sold. for whatever reasons. And so also when we make payments into imports, then our reserves of foreign exchange would fall. So any change, be it an increase or decrease in gold or foreign exchange, would figure in this component of the capital account. And now let's get an overall view of the components of balance of payments. As we saw earlier, the balance of payments has two accounts. One is the current account and the capital account. In the current account, we have all those transactions related to the following: export and import of goods and visibles. Secondly, export and import of services and invisibles like shipping services, legal services, financial services, outsourcing, and so on. Thirdly, we have the unilateral transfers, examples of which are donations made to other countries, grant and aids, scholarships given to students abroad, and so on. The next component of the balance of payments account is the capital account, which again is divided into foreign investment. Foreign investment in turn has two components. One is foreign direct investment and the other is portfolio investment. Then we have borrowings. Borrowings again has two parts. Borrowings for commercial purposes, known as commercial borrowings, and borrowings as external assistance. And then we have the third component of the capital account, which is change in reserves of gold and foreign exchange. Here is another concept I want to talk about, and that is balance of trade. Balance of trade is nothing but the difference between visible exports, that is exports of physical goods, and visible imports, that is imports of commodities or goods across countries. So it is shown here symbolically. Exports minus imports will give us the figure of balance of trade. Here we have an illustration which will help you to understand the concept of balance of trade better. You have here possible trade positions. Either you could have exports being more than imports. And if that is the case, then we have a favorable balance of trade. There is a surplus. And in case the level of exports is lower than the level of imports, then you would have a situation of unfavorable balance of trade. There would be a trade deficit on the balance of trade account. Having learned about balance of payments under the topic Open Economy, we will continue with this topic and learn more in my next teaching module. Before I wind up, just a wee bit of advice to my youngsters. I would advise you to enjoy the learning experience. Enjoy and love to learn. Learn anything that you could get your hands on. It doesn't have to be, only the subjects that you are learning or you have chosen. And under the new education policy, you could just choose any subject you like and be interested in it and learn more about the world around you. And that could surely, enhance your prospects of getting a very good job. And nowadays, knowledge is king. And so if you love to learn, the sky is the limit.